Okay, let's unpack this. Today, we are diving deep into something pretty fundamental. It's the infrastructure that makes our everyday financial life actually work. We're talking about the seemingly invisible plumbing of money transfer. You know, the system that lets you pay for your coffee or, well, send large sums instantly.
It's the hidden engine room.
Exactly. And our focus today is the law governing it all. The National Payment System Act, the NPS Act 78 of 1998. So this deep dive, it's really about getting clear on its purpose, its structure, and honestly, its huge legal significance. This is the act that's meant to ensure financial stability here in South Africa.
It really is foundational.
So the act's official purpose is pretty broad, right? It says it provides for the management, administration, operation, regulation, and supervision of payment, clearing, and settlement systems.
It covers the whole life cycle.
Yeah, and looking at the sources, its history goes back to October 1998. But it's not static, is it?
None at all. It's definitely a living document. It's been updated quite a bit over the years.
Yeah. The last big changes were incorporated back in, February 2014.
That's right. Which, as we might touch on later, is actually quite a while ago in tech terms.
True. So to really get why this law is so crucial, maybe we need to understand the journey money takes and the jargon the act uses.
Exactly. You have to break down the process. The act really hinges on, let's say, three core technical ideas. First up, you've got the payment system itself. Think of that as the whole environment, the infrastructure that lets money move around.
Okay, the big picture.
Right. But within that system, there are these two really distinct technical steps that the law focuses on. The first is clearing. Now, the Act defines this as simply the exchange of payment instructions.
So like Bank A telling Bank B, hey, my customer owes your customer 500 Rand. Just the message.
Precisely. It's the information exchange. They're swapping instructions, figuring out who owes what to whom, often calculating the totals between just those two.
Got it. Instruction swapping.
Then the second step is settlement. Now, this is the really critical bit. This is when the debt actually gets discharged. The money, or the value, actually moves. The Act calls it the discharge of settlement obligations.
Ah, okay. So clearing is the what, settlement is the done.
You could put it that way. And there's often a process before settlement called netting. This is where participants figure out the net amount owed between maybe several parties. So instead of 10 small transfers, maybe there's just one or two bigger ones.
It makes sense. Reduces the traffic.
Exactly. It makes the whole settlement process much more efficient.
Okay, so we've got the mechanics, payment system, clearing, settlement, netting. But why legislate this? Why enact with, potentially serious penalties? What's the absolute worst case scenario this law is built to stop?
Well, that brings us to the absolute core reason for the Act. It's defined right there in Section 1, systemic risk.
Systemic risk. Okay.
You could think of this entire Act really as a huge, complex piece of engineering designed to contain that one specific threat.
Which
systemic risk is the danger that if just one participant in a settlement system fails to pay what they owe, maybe they go bust overnight, that failure could cascade. It could trigger a chain reaction where suddenly all the other participants can't meet their obligations either because they were expecting money from the failed one.
Oh, wow. A domino effect.
Exactly. It's a potential for the entire financial system to just seize up. Confidence evaporates. Money stops flowing.
Right. That sounds like a nightmare scenario.
It is. And this legislation is essentially the safety harness designed to prevent that kind of catastrophic failure.
Okay, that makes the need for regulation crystal clear. So if systemic risk is the big bad wolf, who's the hunter? Who's in charge of stopping it?
Well, naturally, that responsibility falls squarely on the shoulders of the South African Reserve Bank, the SARB.
Makes sense. The central bank.
Section 2 makes it absolutely clear. The SARB is the top dog here. They exercise all the powers, perform all the duties the Act lays out, and this lines up perfectly with their overall mandate under the SARB Act for, financial stability.
And they can delegate these powers internally.
Yes, the board can delegate powers and duties to SARB officers. It gives them the operational flexibility they need to actually manage this day to day.
Okay, so SARB is the ultimate supervisor. But they don't do it all alone, right? I see mention of a sort of self-regulatory body.
That's right. The Act allows for a really important layer of industry self-governance. That's the Payment System Management Body, or PSMB.
PSMB.
Under Section 3, the SARB has the power to formally recognize a PSMB. And the job of this body is basically to organize, manage, and regulate how its members think the major banks and financial institutions participate in the payment system.
So it's like the industry managing its own affairs, but under the SARB's watch.
Pretty much. But SARB sets strict conditions for recognition. Section 3, subsection 2 lays them out. The PSMB has to fairly represent the interests of its members. Its rules need to be fair, equitable, and transparent. And critically, its whole setup must allow the SARB to properly oversee what's going on.
And what does the PSMB actually do? What are its objectives under Section 4?
Well, it acts as a forum for discussing policy within the industry. It's a communication channel between members, with the government, supervisors, the media, the public, and it fosters cooperation among the players in the payment system. It's about coordination.
So SARB oversees, PSMB helps organize. But SARB can also zoom in on specific parts of the system, these designated settlement systems.
Yes, that's another key power under Section 4A. The SARB can formally designate a specific settlement system.
Designate it as what? Particularly important.
Essentially, yes. If the SARB decides that designating a particular system is crucial for the integrity, effectiveness, efficiency, or security of the whole payment system, they can do it through a formal notice in the Government Gazette.
And what does designation mean in practice?
It means that system comes under much closer scrutiny. It's subject to specific terms and conditions set directly by the Reserve Bank. It's the SARB saying, okay, this particular mechanism is so vital, we need direct oversight and control over its risk profile.
Right. Very targeted control. Which brings us to something I think is maybe the most powerful part of this act for everyday confidence, the rule of finality.
Ah, yes. Section 5. Absolutely fundamental.
This feels like the bedrock guarantee, doesn't it? That your money transfer isn't just going to disappear in some legal limbo.
That's exactly what it provides. Section 5 states very clearly that once a settlement is done, either through the SARB's own system or a designated system, it is legally final and irrevocable. It cannot be reversed. It cannot be set aside. Full stop.
Just think about that for a second, you listening. That simple sentence means if your company gets paid or your bank receives funds through this regulated system,
Right.
they can immediately count on that money being theirs legally. It just wipes out a huge amount of uncertainty and risk.
It's the foundation of trust in every single electronic transaction. Without finality, the system would grind to a halt.
And this finality is protected by rules about who's actually allowed to do the clearing, right? Section 6.
Yes. The Act restricts who can perform clearing functions. It's basically limited to participants in the Reserve Bank's settlement system or banks, mutual banks, cooperative banks, participants in a designated clearing system, or specific foreign institutions allowed under the Act.
So you need authorization.
Absolutely. And Section 6, subsection 2 makes it clear. Trying to clear payment instructions if you're not authorized. That's an offense.
Okay, so stability and finality are key. But the Act also touches on fairness, doesn't it? Section 6A.
It does. It's not just about preventing collapse. It's also about ensuring the system works effectively and efficiently, and part of that is fair play.
How so?
Well, Section 6A is quite direct. It says a person can't change, manipulate, or apply a payment system in a way that gives preferential treatment to one payment instruction over another.
Unless the law requires it, I assume.
Right, unless it's prescribed by some other law.
Okay.
But generally, no queue jumping allowed based on favoritism.
That seems important, especially with instant payments becoming common.
Very important. And there's another fairness aspect, too. Access. The criteria for accessing any payment system have to be fair, transparent, and equitable.
Meaning
Meaning if an institution, say a new fintech bank, meets those publicly stated fair criteria, they cannot be denied access.
so it prevents the big players from just locking out competition.
That's the intention. It promotes an open and competitive environment built on that stable foundation.
Okay, let's tackle the real stress test then. What happens if a participant, like a major bank, actually does fail? If it goes into curatorship or even liquidation? This is where Sections 8 and 9 come in, and they sound incredibly powerful.
They are. This is where the MPS Act really shows its teeth and prioritizes system stability above almost everything else. Section 8, subsection 1 kicks things off with a pretty stunning statement. It says the provisions of this act apply. Despite anything to the contrary in other major laws, it specifically names the Companies Act, the Banks Act, and general insolvency law.
Wait, hang on. Did you just say this act overrides things like the Companies Act and standard insolvency procedures in this context?
That's exactly what it says. It's a massive legal assertion.
Wow. So what does that mean for, say, a liquidator appointed to wind up a failed bank?
It means, according to Section 8, subsections 2 and 6, that the curator or liquidator is still bound by the rules of the settlement system. They cannot simply claw back payments that were declared final and irrevocable under Section 5 just because the bank they represent has failed.
So the finality rule holds even in bankruptcy. The system's integrity comes first.
Absolutely. System stability trumps the individual institutions or its creditors' claims on those specific settled funds.
And Section 9 adds another layer of protection, something about collateral.
Yes. If a participant lodged assets as security collateral with the SARB or a designated system operator to guarantee their settlement obligations, Section 9 says those assets can be used by SARB or the operator to cover the failed participant's debts within the system. And crucially, this can be done despite the normal rules of insolvency that might otherwise freeze or distribute those assets differently.
It's like ring-fencing the payment system, protecting it from the fallout of one failure.
That's a very good way to put it. It seals off the core system from contagion.
Okay, so those are the safety nets. What about proactive enforcement? How does SARB police the system day-to-day? Directives.
Right. Section 12 gives the SARB the power to issue directives. These are formal orders. They can issue a directive if they believe someone is engaging in conduct that results in, or is likely to result in, systemic risk.
So they don't have to wait for the disaster.
No, they can act preemptively based on risk assessment. They can also issue directives if conduct is just generally contrary to the public interest regarding the system's integrity, effectiveness, efficiency, or security.
And what can these directives demand?
They can order a person to stop the problematic action immediately. They can require them to take specific steps to remedy the situation, or they can demand specific information.
And these aren't just suggestions, presumably. There are consequences.
Oh, absolutely. These directives are binding. And ignoring them or breaking other key rules like the clearing authorization we discussed carries serious weight.
How serious?
Section 14 spells out the penalties for offenses under the Act. It could be up to a 1 million rand fine or 5 years imprisonment, or potentially both.
Okay, are 1 million or 5 years? That's significant. That's real legal force backing up the SARB's authority.
It ensures that directives are taken very seriously,
Yeah.
and compliance is, well, usually swift.
Now, even with the powerful regulator like SARB, disagreements must happen sometimes, right? Between SARB and a bank, for instance.
Of course.
Yeah.
And the Act anticipates this. Section 11 provides a clear process for resolving disputes.
So it's not just SARB says jump, you ask how high.
No, there's a due process guaranteed. If a participant feels aggrieved by a SARB decision related to the Act, they first have to try and reach consensus with SARB. They get 7 business days for that.
And if talking doesn't work?
Then they can agree to go to mediation within another 10 business days.
Yeah.
They split the mediator's costs.
Okay, mediation.
They're
And
gonna
then
pay.
if that fails.
If mediation doesn't resolve it, the dispute must be referred to a single arbitrator. This arbitrator needs to be knowledgeable in both law and the payment system itself.
Yeah.
And here's the key part. The arbitrator's decision is explicitly stated to be final and binding.
Final and binding. So no lengthy court appeals.
Correct. It ensures disputes get resolved relatively quickly and decisively, which is important for maintaining the smooth functioning and certainty of the payment system. You can't have these things dragging on for years.
Right, you need things to keep flowing. Okay, so let's try and pull this all together for you, the listener. What we're seeing is that the MPS Act is really this foundational legal structure. Its main job is managing that scary systemic risk we talked about.
Keeping the dominoes from falling.
It does this by making settlements absolutely final and irrevocable. That's your guarantee. It controls who can participate, ensures fair access, and crucially, it gives the Reserve Bank some very strong tools. The power to designate critical systems, issue binding directives, and impose hefty penalties.
It's the framework that allows you to confidently hit send on that EFT or tap your card or use whatever new payment app comes along. That feeling of safety and immediacy, that the transaction is real and won't be undone, that's underpinned by this act. It's the invisible legal scaffolding, as you said earlier, holding up a huge part of our financial lives.
But scaffolding needs maintenance, right?
Yeah.
Especially in finance and tech, things change so fast.
They certainly do. And the act actually acknowledges this. Section 15 mandates the creation of a standing committee.
Made up of.
Representatives from the Reserve Bank and the PSMB. Their job is specifically to review the act periodically. They need to consider changed circumstances and recommend necessary amendments to the Minister of Finance.
Which brings us back to that 2014 date for the last major update.
Exactly.
So here's the final thought for you to chew on. We haven't seen major incorporated updates since February 2014. In the decade since then, think about what's exploded onto the scene. various forms of distributed ledger technology, stablecoins, truly instant global payment networks. What specific current financial innovation do you think that standing committee, mandated by Section 15, is likely wrestling with right now? What are they trying to figure out how to regulate or maybe accommodate to make sure this 1998 framework, even with its updates, can still effectively manage risk in today's and tomorrow's financial world?
That's the perpetual challenge, isn't it? Legislating for stability when the technology refuses to stand still.
Indeed. A lot to think about there.